Welcome to the Explainer from Talk Tickers. Today, we're breaking down H.B. Fuller's fourth quarter 2025 earnings call from January 15th, 2026. This one is a classic beat and miss scenario, so let's dig in and figure out what's really going on.
So let's jump right in. The story of H.B. Fuller's quarter is, a classic tale of two tapes. You've got a miss on the top line, the revenue, but a really clear beat on the bottom line, which is profit. And this really sets up the big question for investors. Can the quality of their earnings make up for that sluggish growth? To get to the bottom of that, let's look at the headline numbers and see how they actually stacked up against what Wall Street was expecting. All right, here we go. As you can see, the company delivered adjusted earnings per share of $1.28. That's a nice beat compared to what analysts were thinking. But on the flip side, revenue came in at $895 million, and that fell just a bit short of expectations. And that $1.28 EPS, well, that translates to a solid 4-cent beat. Now, this isn't just a tiny win, It's a really clear sign that they have strong operational control. It proves they can absolutely manage that bottom line, even when sales are a little tough. But then there's the revenue, that $895 million figure. It's actually a 3.1% decline compared to last year. And you can bet this is the number that really caught the market's attention. It kind of frames the whole challenge for the company going forward. Okay, so this brings us to the crucial question, right? How in the world did they grow their profit when sales were actually down? Well, the answer is all about a laser focus on profitability. It's quality over quantity, plain and simple. And the CEO, Celeste Mastin, she really hammered this point home on the call. The message is crystal clear. This isn't about chasing growth for growth's sake. It's all about achieving higher margin, more profitable growth. And wow, this chart really shows you they're not just talking the talk. Both their adjusted gross margin and their adjusted EBITDA margin expanded by an impressive 290 basis points. For those of you keeping square at home, that's a 2.9% jump year over year. This margin expansion was the absolute core engine of their earnings beat. So what was the engine behind that incredible margin expansion? Well, it was a very deliberate trade-off. They managed to get higher prices, up 1.2%, even though it meant their sales volume dipped by 2.5%. This shows a clear strategy, right? They're protecting their profits, instead of just chasing every single dollar of revenue out there. Okay, so that's the story of the last quarter. But what about looking ahead? How does this all translate into their outlook for 2026? Well, management made it super clear. They are not counting on a favorable economy to hit their targets. This is what you'd call a self-help story. And their guidance for the full year really doubles down on this margin story. They're telling us to expect net revenue to be somewhere between flat and up 2%, but look at the adjusted EBITDA and EPS. That's some serious growth, all while organic revenue is expected to be just about flat. So what does that tell you? All that growth is coming from their own execution, not from a booming market. Now, they also gave us a heads up that Q1 revenue is going to be down a little, low single digits. But, and this is super important to note, this isn't some big red flag about demand. It's really just about the timing of the Chinese New Year, which is going to push some of that revenue into the second quarter. So it's more of a calendar thing than a business problem. So let's put all these pieces together. What's our take on H.B. Fuller heading into the next quarter? Time for the next call. So for anyone invested in Fool or thinking about it, here's the billion-dollar question, right? Can this margin-focused strategy actually drive the stock higher? Or is that lack of top-line growth going to act like an anchor and just hold it back? All right, we've broken down our call into 3 quick parts for you. What we expect to see next quarter, how we think the stock is going to react, and of course, our official rating. First up, next quarter's results. We think they're going to come in right in line with that cautious guidance they gave, no big surprises. And the whole story, the whole debate is going to stay focused on that same theme, great margin execution versus soft volume. Second, what's the stock going to do? Well, we expect it to pretty much trade sideways for a while. Think of it this way. That strong margin performance puts a really solid floor under the stock price. It's not likely to tank, but that lack of volume growth puts a ceiling on it. There's just not a clear catalyst to push it higher right now. And that brings us to our rating, market perform. Look, H.B. Fuller is executing its profitability plan exceptionally well, and you've got to give them credit for that. But until that organic growth really starts to pick back up, the stock is probably just going to perform in line with the broader market. So, not bad, but not an outperformer either. And as always, a quick reminder, this is not financial advice.